1. The foundation, Vanguard S&P 500 ETF, VOO. When it comes to investing, there's one thing that separates those who build real wealth from those who constantly chase trends: consistency. And that's exactly what makes the Vanguard S&P 500 ETF such a powerful tool. It's not about timing the market or hunting for the next big stock. It's about owning a piece of the 500 most successful companies in America and letting time do the heavy lifting. Think about it. Some of the world's biggest companies like Apple, Microsoft, Amazon, and Google are all packed inside this single fund. These companies drive the global economy. They innovate, they expand, and they generate billions in revenue year after year. And by holding VOO, investors don't just own one or two of them, they own all of them. This is why the S&P 500 has historically returned around 10% per year over the long run. It's not magic, it's just the power of compound growth. A simple $10,000 investment in the S&P 500 back in 1980 would be worth over $1.1 million today, without picking a single stock, without checking the market every day, and without trying to guess what's going to happen next. That's the beauty of investing in an index like VOO. It allows wealth to grow naturally as the economy expands. Instead of stressing over individual stock movements, investors can simply ride the wave of long-term economic progress. While some years may see market downturns, history has shown that the S&P 500 always recovers and continues its upward trajectory. The biggest companies in the world are constantly evolving, innovating, and driving new sources of revenue, ensuring that long-term investors benefit from the power of the market. And the best part? It requires almost no effort, just patience and discipline. And here's where it gets even better. VOO is one of the cheapest ways to invest. The expense ratio is just 0.03%, meaning for every $10,000 invested, the cost is only $3 per year. Compare that to traditional mutual funds that charge 1% or more, and the difference over time is massive. High fees quietly eat away at returns, but with VOO, nearly every dollar invested stays where it belongs, in the portfolio, growing over time. Now, while VOO is a great foundation, it has one small limitation: it doesn't provide regular cash flow. And that's where the next ETF comes in. 2. The income engine, Schwab US Dividend Equity, ETF SCHD. Growth is great, but what if an investment could pay out real cash along the way? That's the power of dividend stocks, and that's exactly what the Schwab US Dividend Equity ETF is built for. SCHD is laser-focused on companies that don't just pay dividends, but grow them consistently. Think of it like this: some stocks might give out high dividends, but if those payouts aren't sustainable, they won't last. SCHD filters out weak companies and focuses only on financially solid businesses that can keep rewarding investors year after year. Right now, SCHD's dividend yield is around 3.6%, which means a $10,000 investment generates about $360 per year in passive income. And the best part, that income keeps growing. Over the past 5 years, SCHD's dividend payments have increased by an average of 12% per year. That means even if inflation rises, the income from SCHD keeps up, something that cash savings can't do. Unlike bonds, which have fixed payouts, dividend stocks in SCHD belong to companies that actively increase their payments over time. This means that the longer an investor holds SCHD, the more their income grows without having to lift a finger. And because these companies are financially strong and consistently profitable, they can weather economic downturns while still rewarding investors. Instead of relying on unpredictable stock price movements, SCHD provides a steady stream of cash flow that can be reinvested for even greater compounding growth. This makes it an excellent choice for those who want both stability and the ability to generate passive income well into retirement. The companies inside SCHD are household names: Coca-Cola, Home Depot, PepsiCo, and Texas Instruments. These businesses aren't just profitable, They have a track record of weathering economic downturns and still paying dividends. But SCHD isn't just about the dividend income, it's also a strong performer. Over the past decade, it has delivered an average annual return of 12%, meaning investors aren't just getting paid, they're also growing their wealth at the same time. VOO builds the foundation, SCHD brings in passive income, but every strong portfolio also needs a high growth component, and that's where things get really interesting. 3. The Innovation Accelerator, Invesco Nasdaq 100 ETF, QQQM. Every major technological breakthrough of the past 2 decades, smartphones, AI, cloud computing, self-driving cars, has been driven by a handful of companies. And guess what? They're all in the Invesco Nasdaq 100 ETF, or the QQQM. QQQM tracks the Nasdaq 100 index, which means it holds 100 of the biggest, most innovative companies outside the financial sector. And this isn't just any list. This is a collection of businesses shaping the future. Apple, Microsoft, Nvidia, Amazon, Tesla, Meta, Google. The companies in QQQM are the ones driving the next wave of technological progress. Over the past 5 years, QQQM has returned 78%, far outpacing the S&P 500. Why? Because these companies grow fast. They reinvest earnings into research, launch new products, and dominate their industries. The tech giants within QQQM, Apple, Nvidia, and Microsoft aren't just keeping up with trends, they're creating them. Whether it's AI, cloud computing, or digital payments, these firms are at the forefront of change. While tech stocks can be volatile in the short term, innovation-driven businesses tend to outperform over time. By holding QQQM, investors gain exposure to this rapid innovation without picking individual winners. The index naturally adjusts, keeping the most dominant companies, ensuring the portfolio remains positioned for growth. Now, many investors are familiar with QQQ, which tracks the same index. But QQQM is actually the better choice. It offers the exact same exposure with a lower expense ratio of just 0.15% compared to QQQ's 0.20%. That means more money stays in the portfolio, compounding over time. High-growth stocks can be volatile, and that's why they work best alongside stable investments like VOO and SCHD. But there's one more missing piece, a defense mechanism for when the market takes a hit. The stability factor, Vanguard Value ETF, VTV. Not every stock needs to be a high-flying growth play. Some of the best investments are the ones that simply hold their ground and generate steady returns, even when the market is in chaos. That's where the Vanguard Value ETF, VTV, comes in. VTV is designed to balance out market volatility by investing in value stocks, companies that are financially strong but often undervalued. These businesses may not be making headlines every day, but they are consistently profitable, stable, and built to last. Inside VTV, you'll find companies like JP Morgan, Procter & Gamble, United Health Group, and ExxonMobil, massive businesses with reliable cash flow and low debt. These are the kinds of companies that don't rely on hype to perform. Instead, they quietly grow and reward investors with solid returns over time. And there's another reason value stocks deserve a place in every portfolio. They tend to outperform during bear markets. While high-growth stocks can be hit hard during downturns, value stocks act as a stabilizer, keeping portfolios from sinking too deep. On top of that, VTV also provides a steady dividend yield of 2.2%, meaning investors get some passive income along the way. And just like the other ETFs in this list, it comes with ultra-low fees, only 0.04% per year. This is why VTV is the final piece of the puzzle. It ensures the portfolio isn't just focused on growth, but also on stability and risk management. These 4 ETFs each serve a specific purpose, but together, they create something even more powerful: a portfolio that thrives in any market condition. VUO provides broad market growth with exposure to America's 500 biggest companies, ensuring that investors benefit from the consistent, long-term rise of the U.S. economy. It serves as the foundation, giving access to industry giants that drive economic progress. Meanwhile, SCHD delivers passive income through reliable dividend-paying stocks, offering not just stability, but also a consistent cash flow. This makes it an excellent choice for those who want to see returns, even when the market is uncertain. At the same time, QQQM captures the high-growth potential of the world's most innovative companies, focusing on technology-driven businesses that are reshaping industries and pushing the boundaries of progress. These are the stocks that have the potential for exponential growth, making them a key component for those looking to maximize returns. Lastly, VTV adds stability and downside protection, ensuring that the portfolio stays strong even in rough markets. By focusing on value stocks, companies that are financially strong but often overlooked, VTV acts as a safeguard, balancing out volatility and helping the portfolio maintain steady performance through different market cycles. The best part? This strategy is incredibly simple. There's no need to constantly check stock prices, trade in and out of positions, or worry about market timing. It's all about buying, holding, and letting time work its magic. If this breakdown helped simplify investing, hit the like button and subscribe for more straightforward investing strategies every week. Drop a comment. Which of these ETFs do you see playing the biggest role in your portfolio?